What if you had the power to see into the future? What would you do? Most would say they would play the lotto since they already know the winning numbers. It's guaranteed easy money. Perhaps you will look 10 or 20 years from now to see what company is the next Amazon. You will get in on the ground floor and sit back while your investment brings you big gains in the future. But the real world doesn't work like that. You still have to play those low odds in the lotto and endure the risk of investing. But what if there were a select few people that did have the ability to look into the future and trade stocks risk-free in a way that guarantees they always win? And the catch is, you're helping them do it. Modern day stock trading is much different than what it used to be. Today, it mostly looks like this. Back then, people used to actually match up orders of people who are looking to buy and people who are looking to sell. Now computers do this at a much faster and effective rate. The New York Stock Exchange moves around $20 billion per trading day. That's around $83 million an hour, and this is all done by computers. This is good for everyday people, since it makes investing a lot easier to get into. Nowadays, you can just download an app on your phone and start buying and selling whatever stocks you want. With this change, it also brought trading fees down. Now you can trade commission-free on multiple platforms. But as we know, nothing is truly free. Broker companies still have to make money somehow. And since they aren't charging you to make trades, they are looking for other ways to make money. One way they make money is from selling your orders to high-frequency traders. In 2018, Charles Schwab, one of the biggest brokers on the market, made around $139 million from selling customers' order flow, which was up around 22% from the previous year. Some regulators are persisting that this practice has to be stopped, or tax the high-frequency traders that are making millions of trades per day. In Canada, they banned the sale of order flow, and in the UK, they are looking to limit this practice. These high-frequency traders are trading firms that use computers to run complex algorithms to automatically execute trades. They use your orders to determine what price someone is willing to pay right now at this moment. The computer in milliseconds buys the stock at a slightly lower price. This could be as little as a fraction of a penny. They then fill your order and sell you their shares that they just have bought. They do this millions of times a day and never make a losing trade. It was estimated that these institutions make around $250 billion a year from buying order flow and filling those orders. This is like looking into the future and knowing what the price of a stock will be tomorrow. The practice of buying order flow was pioneered back in the 90s by Bernie Madoff. Yes, the same Madoff that created a $65 billion Ponzi scheme that came crashing down in 2008, but that's for another video. We are seeing the effects of high-frequency traders and algorithmic trading is having on the market. On May 6, 2010, the Dow Jones Index dropped 1,000 points, or around 9% of its total value. It then rebounded back to normal levels. This all happened within 15 minutes. These steep drops in small amounts of time are known as flash crashes, and they are making markets more volatile than ever before. If you want to know more about high-frequency trading and how they operate, I recommend the book Flash Boys, A Wall Street Revolt by Michael Lewis. It gives a great in-depth look at how algorithmic trading works. What do you think about brokers selling your order flow? Is high-frequency trading and algorithmic trading just part of the game? Do you think this is good for markets in general, or is it something that should be regulated? Or if you have any other comments, I would love to hear what you have to say. Thanks for watching.